Welcome to the Deep Dive. Today we're really opening up the source stack and plunging into NVIDIA Corporation. Ticker is NVDA. Of course, if you follow the tech sector at all, you know they're just a huge force in semiconductors, especially, well, everywhere in AI right now.
That's absolutely right. And for this dive, we've got quite a bit of material laid out here. There's a detailed report, loads of financials, insights from their very latest earnings call, plus a bunch of news headlines, what analysts are saying, and, other key data points. It's a pretty comprehensive stack.
Yeah, it is. And our mission really is to cut through all that noise, pull out what's genuinely important according to these sources, and put it into context for you. So by the end, you should have a much clearer picture of NVIDIA's recent performance, understand the powerful engines driving their growth, face the significant challenges they're grappling with, which are detailed in these sources, and just get a feel for how analysts are viewing things right now. It's all about getting you informed on NVDA quickly but thoroughly, drawing only from the material we have in front of us.
Exactly. So let's maybe kick things off with a snapshot of their recent performance based on the report. We see the stock price mentioned around $137.38 USD, and it had a positive day, up about 1.67% when this data was pulled. But, that's just one day. The really big story, according to these sources, is their Q1 results for fiscal year 2026. They were, well, pretty remarkable.
Remarkable seems like an understatement. The report says total revenue hit $44.1 billion. That's a 69% jump compared to the same time last year. And even sequentially from the previous quarter, it's up 12%. That's massive growth on top of already huge numbers. Where's it all coming from, according to the sources?
Well, the report makes it crystal clear. The data center segment is just the powerhouse here. Data center revenue alone was $39.1 billion in Q1. If you do the quick math, that's nearly 90% of their total revenue, and that segment grew 73% year over year.
Wow, 73% in their main business line. That's just incredible acceleration. And what about profitability? The report mentions strong gross margins, right? 60.5% GAAP, 61.0% non-GAAP.
That's right, strong numbers. But there's a really important footnote in the source material there. It specifically points out that if you exclude a particular charge, and this charge is related to the China market, something we definitely need to dig into, that non-GAAP gross margin would have been much higher, like 71.3%.
Okay, so that exclusion immediately tells you something significant happened related to China that impacted the reported profit in Q1. It gives a cleaner look at the sort of underlying operational margin, which was actually very healthy.
Exactly. It flags that issue right away. So the top line is booming, driven by data center. What specifically, based on the material, is pushing that data center growth so hard?
Right. What are the engines?
A couple of key things stand out in the sources. First, just the sheer global demand for accelerated computing, for AI infrastructure. It's still incredibly strong. But specifically for Q1, the report really emphasizes the rapid ramp up and deployment of their new Blackwell platform.
Ah, Blackwell. That's the latest generation, the GB200 super chip and those NVLink racks and things.
Precisely. And the material uses this specific phrase. It calls it the fastest ramp in the company's history.
The fastest ramp ever. For a company like NVIDIA, that's saying something.
It really is. Think about it. Decades of launching high-performance tech, and this one is the fastest. It points to, unprecedented execution, manufacturing scale, and just immediate market hunger for it.
That's fascinating. It's not just demand, it's their ability to deliver at this scale. And the report says Blackwell drove almost 70% of the data center compute revenue in Q1.
Exactly, 70%. Which also tells you the transition from their previous big platform, Hopper, is moving along very quickly, nearing completion, actually. The market wants the latest and greatest.
Makes sense. And it's not just the main chips, is it? The sources also mentioned networking.
Yes, absolutely. The report points to growing demand for things like NVLink. That's the tech connecting the GPUs inside servers, and Spectrum-X, which connects whole clusters of servers. The source actually puts a number on this networking piece, saying it's now annualizing over $8 billion in revenue.
$8 billion just for the networking components. So it really underscores their whole platform strategy, right? It's not just chips, it's the interconnects, the software, the whole ecosystem.
It's definitely a key part of their value proposition and, you could argue, their competitive edge. And interestingly, the report highlights that it's not just the usual hyperscale cloud companies driving all this growth anymore. We're seeing, according to the sources, the emergence of new growth drivers.
All right, I saw that mentioned. Sovereign AI was one term used.
Correct. Sovereign AI. Basically, nations themselves investing big money to build their own national AI capabilities. That's a whole new category of very large customers. The report also mentions enterprise AI, so companies bringing AI workloads in-house, on-premise, and industrial AI using platforms like Omniverse and Isaac.
Omniverse for digital twins and simulations. Isaac for robotics.
Yeah.
Yeah, those sound like potentially huge new markets opening up, broadening their reach beyond the cloud giants.
Definitely seems that way based on the source material. And, while data center is clearly the main event, the report does note that their gaming segment is doing well too.
Yeah, gaming had a record quarter in Q1, $3.8 billion revenue, I think it said,
Yeah.
driven by new graphics cards like the RTX 5070 and 5060 and that DLSS tech.
Right. DLSS, deep learning super sampling. It's basically AI boosting graphics performance. It's another example of how AI is filtering into, well, everything they do, even consumer gaming.
Okay, so phenomenal growth, clear drivers, new markets emerging. But now we need to address the elephant in the room, which the sources detail quite starkly, the China export controls.
Yeah, this is a really crucial piece of the puzzle presented in the report, and it ties directly back to that margin adjustment we talked about earlier. The U.S. government put new restrictions in place, specifically hitting high-end data center GPUs going to China. This included the H20 chip, which NVIDIA had actually designed for that market to comply with earlier rules.
And the impact was immediate and quantifiable, according to the sources.
Very much so. The report states it essentially shut down their previous Hopper generation data center sales in China, and maybe more significantly, it suggests these controls have effectively closed off what's estimated to be a roughly $50 billion China AI accelerator market to U.S. companies like NVIDIA, at least for now.
$50 billion market, just closed off. And the financial hit in Q1.
It was substantial. The report details a $4.5 billion charge taken in Q1. That was mostly for excess inventory they were stuck with and purchase commitments they had made for components they could no longer use for products destined for China.
$4.5 billion. That's a huge hit to the bottom line in one quarter, directly because of these regulations.
Huge. And on top of that, the report says they couldn't ship $2.5 billion worth of H20 products that were planned for Q1 because the rules changed. So that revenue just vanished for the quarter.
And this isn't just a Q1 issue, right? The impact carries forward.
It does. The company's Q2 revenue guidance, which is around $45.0 billion already, accounts for an estimated loss of about $8.0 billion in planned H20 revenue that they expected to ship to China in Q2. The report is very explicit. Management expects this loss of market access to have a material adverse impact going forward.
Material adverse impact. And beyond the lost revenue, the sources point out another potential consequence, don't they? About competitors.
Yes, this is a really interesting point from the report. It explicitly states that this situation could end up benefiting foreign competitors. And it even includes a comment attributed to the CEO suggesting the restrictions are actually, maybe ironically, spurring China's own domestic innovation and scale in this area.
So the controls might be unintentionally boosting the very competition they were perhaps aimed at containing. That's complex.
It's definitely a complex geopolitical dynamic with direct business consequences outlined here. The report mentions they're looking at limited compliant options for China, but it doesn't paint a picture of a quick return to how things were.
Right. Okay, so looking ahead then, what else does the Q2 guidance tell us, besides that big H20 impact?
Well, as mentioned, the guidance is roughly $45.0 billion, plus or minus 2%. The fact that they're guiding for sequential growth at all, even with that $8 billion estimated hit from China, really speaks volumes about the underlying demand strength in the rest of the world.
That's a good point. Yeah. Margins are expected to bounce back sharply in Q2.
Yeah, the guidance is for 71.8% GAAP and 72.0% non-GAAP gross margin. That's much closer to that underlying operational level we saw if you excluded the Q1 charge. The report suggests they're aiming for the mid-70s later in the fiscal year, indicating Q1's hit was seen as, well, a specific event.
And they're investing heavily for the future, too, based on the sources. Operating expenses are going up.
Significantly, OPEX increased sequentially in Q1, and the report projects growth in the mid-30% range for the full fiscal year. These are major investments.
And what are they investing in, according to the report?
It's focused on supporting this massive global AI infrastructure build-out, expanding their own platform capabilities, and, crucially, significantly expanding their supply chain capacity. This includes making long-term purchase commitments, specifically mentioning support for U.S. onshore manufacturing efforts. Securing supplies seems paramount.
Makes sense if the demand is this strong. And they also committed to something about their product cycle.
Yes, an annual product cadence. The report says they have a roadmap through 2028 with plans to launch a major new architecture basically every year.
Every year, that's incredibly fast for semiconductors. That's aggressive.
It's very aggressive. It seems designed to keep pushing the performance envelope and stay ahead of any potential competition. Shows a lot of confidence in their R&D engine.
Okay, let's zoom out a bit. How does the source material frame their overall market position and valuation? We know the sector, technology, and industry, semiconductors.
Right. The report assigns them an economic moat rating, but it's rated as narrow.
Narrow. Given everything we've just discussed about their dominance, that might surprise some people. Why narrow, according to the source? What are the strengths and weaknesses they identify?
So the strengths underpinning the moat, according to the source, are pretty clear. Their leadership in AI-accelerated computing, obviously highlighted by Blackwell's success, their whole platform approach, integrating networking, software, hardware, creates that sticky ecosystem, and their central role in the global AI build-out, including these new sovereign AI customers, those are the moat-building factors.
Okay, so what limits it to narrow?
The report points directly back to the China export controls. That material impact, the loss of a major market access point, introduces significant geopolitical risk, and crucially, that point we discussed earlier, the risk that these controls could inadvertently help foreign competitors gain ground. That uncertainty about the long-term competitive landscape stemming from this external factor is why the source seems to cap the moat rating at narrow.
So, dominant now, but with a tangible external threat casting a shadow on the long-term durability. That's a key takeaway from the source's analysis.
Exactly. Now, turning to valuation metrics provided in the report, the stock price at the time, $137.38, is noted as being just slightly below the source's own calculated fair value estimate of $141.40.
Okay, slightly undervalued by their metric. How does that compare to what other analysts are saying based on the data provided?
Well, the source includes the average analyst price target from the last 6 months, which is quite a bit higher, around $169.70, and it lists several recent individual targets from different analysts, some hitting $170, even $180. So on average, the analysts cited seem more bullish than this specific report's fair value estimate.
Interesting divergence. The report also threw out some ratios, right? PE, PS, etc.
Yeah, standard valuation ratios. For context, it mentions a trailing 12-month PE ratio of 43.02 and a forward PE, based on expected earnings, of 30.86.
So, still high multiples. But the forward PE being lower suggests strong earnings growth is expected, which brings the multiple down relative to future earnings.
That's the general interpretation, yes. High growth expectations are definitely baked into the current valuation, as these ratios from the source suggest. It also included price to sales, price to free cash flow, price to book, different ways for you to look at the valuation.
And there was a quick note on insider trading activity in Q1 FY26.
Yes, the source material included a list, and it appeared to be mostly sales transactions by insiders during that period. Just another data point provided in the stack.
Right, and the collection of news headlines.
It sounded like a mixed bag.
Very much so. The list provided showed some headlines that were extremely bullish, focusing on the growth in AI dominance, while others were more cautious, likely reflecting concerns around valuation, competition, and, of course, the China situation we've discussed. Shows the range of views out there.
Okay, so let's try and boil this all down. If you had to summarize the key takeaways from this deep dive, based purely on the source material we've gone through, I think the core story from these sources is one of incredible current strength facing a very significant external challenge. NVIDIA is undeniably leading the AI infrastructure boom. Their growth is staggering, Blackwell adoption is unprecedentedly fast, and they're successfully expanding into new areas like sovereign AI.
And it's a big but.
But that dominance is significantly impacted by the U.S. export controls targeting China. The sources quantify this. Billions in charges, billions in lost revenue, a massive market effectively closed off for now. And the report explicitly raises the risk that this could alter the competitive playing field long-term, potentially benefiting rivals or accelerating China's own efforts. It's a major headwind detailed right here.
Yet, despite that headwind, the underlying business outside of China remains incredibly strong, fueling growth forecasts, even with the China loss factored in. And they're doubling down on investment in R&D, supply chains, and that super fast annual product cycle.
Exactly. It's a picture of remarkable execution navigating a really complex and risky geopolitical environment, all laid out in these source documents.
Okay, so based on everything we've just unpacked from these sources, what really stands out to you, the listener, how do you personally weigh that incredible growth story against the very real, quantifiable geopolitical risks outlined in the report.
Yeah, and thinking about that explicit warning from the source that the export controls might actually help form competitors or boost China's internal innovation, how do you see the global AI race potentially shifting in the coming years? What could that mean for NVIDIA's dominance down the road, even with their aggressive roadmap?
Really gives you a lot to think about, drawing just from this material. If you found this deep dive valuable, if getting this kind of focused analysis based on source data helps you stay informed, we'd really appreciate your support. If you're watching or listening on YouTube, please take just a second right now to hit that subscribe button and ring the notification bell. It genuinely helps the channel reach more people like you and ensures you won't miss our future deep dives.
We really appreciate you joining us for this deep dive today.
Thanks for listening. We'll see you on the next one.